Good afternoon and welcome to our Financial Advisor Forum this Thursday, November 7th. I'm Greg Greenberg from The Street. And closed-end funds have had a rocky year due to all the taper talk coming from the Fed. Will we see a repeat of this in 2014? John Cole-Scott of Closed-End Fund Advisors is here to tell us. Welcome, John.
Thank you.
All right, it was a rough summer for closed-end funds because of all the taper talk. Will we see a repeat of this in 2014 when supposedly the real tapering is supposed to happen?
We think no, because what happened was going into the summer, we had closed-end fund discounts on the bond side at 2-3 premiums on average. Specialty equity, which is a lot of the yieldy funds like REITs and utilities and master limited partnerships, were really at around par to slight premiums. And now the bond funds are trading at 6-7 discounts. So we've got a reversion back to more level of comfortable discount levels for closed-end funds. And we have people understanding that rates are eventually going to rise. And even though they will, and that won't lead to great performance for closed-end bond funds per chance, it's going to still produce, we think, positive total returns for appropriate risk exposure.
And the way you manage money is by something you call the destructive return of capital. Can you explain that?
Well, one of the ways we try to avoid painful closed-end fund experiences is through taking the return of capital portion of a closed-end fund, and we compare its net asset value performance against its net asset value yield, because the concept is if it's paying return of capital, is the portfolio able to actually grow on pace with the payout of the dividend? So if its performance is 9% in the last 12 months and it paid an 8% dividend, then very simply it was earning through growth its distribution. Well, if it's not earning its growth through its performance and it's showing return of capital, we calculate the percentage of the distribution that we feel is destructive return of capital. So it's a data point heavily focused on 1-year NAV performance. It's not perfect, but it helps you pick the funds that even may have return of capital, which is sometimes thought of as bad, that they're actually growing and earning.
What about new issues? Do you avoid those? Certainly there was a drop off in new issues because of all the taper talk.
Yes, there's only been 2 new issues since Bernanke opened his mouth. Maybe 3, but very few, and they were smaller than anticipated. New issues, we need them. We have on average about 14 a year for the last 10 years on average. We've had, I think, 19 so far this year, raising $14 billion in assets. But our research has found that if you can wait 9 months after the IPO, you get on average an 8% better entry point than on the IPO. So it's hard to buy on the IPO, but somebody has to.
And what about volatility in closed-end funds? Should investors be scared of it? Should they welcome it? We're looking towards 2014. What should they be doing?
So when you think of the volatility of a closed-end fund, there's 2 pieces. One is the volatility of the actual manager's portfolio, which is generally, especially for bond funds, going to be higher volatility because they have roughly 1/3 leverage for the average taxable bond fund, which is by just pure results going to mean 20-30% more volatility for net asset value. Where it gets interesting is because 70% of closed-end funds only trade between $250,000 and $2.5 million a day in total liquidity. They're considered less liquid, less efficient vehicles. That makes the net asset value volatility versus the market price's volatility much higher. So the market price volatility is much closer to the S&P 500, like a 14, which is rather high. We don't think that's risky. We think that's opportunity for volatility.
So put it all together, what are the best closed-end fund opportunities in 2014?
We think that places that have been hurt are good for outcomes. So the international equities got some great opportunities. We think that finding the funds that still have discounts wider than 10 with liquidity, like in the covered call space, but not too high of a distribution level, really looking to capture the narrowing of the discount as well as the probable rise of equity markets.
All right. Thanks a lot, John.
Thank you.
And thank you for watching Financial Advisor Forum on The Street. I'm Greg Greenberg. Please come back.